Hello everyone and welcome to the lesson. The subject is Advanced Auditing and Assurance. Today we are going to start revising the paper that was done in December 2023 by the CPA Advanced Level candidates. This question paper has 5 questions. Candidates were required to answer all questions, and we will be answering a question at a time. In today's lesson, we'll answer question 1. In our next session, we'll answer question 2 until we complete the 5 questions. I urge you to attempt the questions before attending these lessons. Make sure you do the questions on your own before coming to this revision session. So let us begin by answering question number 1, which reads, Part A, you are the audit manager of Baraka and Company LLP, who are the auditors of Miradi Limited for the year ended 30th June 2023. The company has net assets of 150 million. The audit has been completed, but there is a matter that has not yet been resolved on depreciation of buildings. The directors of Miradi have resolved that depreciation on buildings will not be provided for in the financial statements. The buildings were acquired in the year 2020 and no depreciation has been provided since. Required Roman 1, describe 6 additional audit procedures and actions that you would take with respect to the above matter. So candidates, here is a problem with the Baraka, Miradi Limited. This is a company that whose net assets are valued at 150 million. But the item on depreciation, we learned that depreciation has not been provided for on buildings since the buildings were acquired in the year 2020. Candidates were required to describe 6 additional audit procedures and actions that could be taken in respect to the above matter. So let us put down the audit procedures, additional audit procedures. This is December question 1. A, Roman 1. What are the additional audit procedures that the auditor should perform in respect to buildings? Now, candidates, the first audit procedure is to review the accounting policies. The auditors should review the accounting policies of this company, the Miradi Limited company. The auditors should conduct thorough review of Miradi Limited's accounting policies related to depreciation, specifically focusing on the treatment of buildings. The auditor should evaluate, in carrying out the review, the auditor should evaluate the consistency of the policies with applicable accounting standards and also the regulatory requirements. Review of accounting policies, because you know, candidates, every company must have accounting policies on different matters. For example, on the estimation of depreciation, company must have accounting policies in relation to depreciation. And therefore, given that there is a problem on the buildings, we've read that the audit has been completed, but there is a matter that has not been resolved on depreciation of buildings. So as the auditors ought to review the accounting policies related to buildings. And in reviewing the accounting policies on buildings, the auditor should evaluate the consistency of the policies with respect to accounting of or treatment of the depreciation on buildings. 2, assessment of the methodology on depreciation. Assessment of depreciation, let me call it depreciation methodology. The auditor should assess the methodology on depreciation. The auditors ought to evaluate the appropriateness of the depreciation method that is applied to buildings. This means assessing whether the straight line method is reasonable or any other method of depreciation. So there are the various methods that the company may use. The straight line method or reducing balance method. So the auditor should evaluate the appropriateness of the method that is used to depreciate buildings. Assess, for example, whether straight line method is reasonable or not. The auditors may also consider alternative methods and their potential impact on the financial statements. There are various methods: the reducing balance method, the straight line method, and so on. Assessment of depreciation methodology. 3 is another audit procedure is in relation to documentation. Inspection, let me call it inspection. The auditor should inspect the documentation related to buildings, of building documentation. Inspection of building documentation. The auditor ought to physically inspect the documentation related to buildings, including purchase agreements, title deeds, and any other relevant contracts. And by so doing, the auditor can verify the accuracy of the acquisition costs and also ensure that no impairment or changes in the useful life have occurred since acquisition. Inspection of buildings documentation. You understand? That is, if the building was bought, then there has to be agreements. If the buildings were constructed, then there are documents related to construction of buildings. So the auditor should inspect the documentation related to buildings. Whether the buildings were bought or even constructed by the company, there are various documents that ought to be inspected, like the title deeds, the relevant contracts, the purchase agreements, and so on. So candidates, we are discussing the additional audit procedures that the auditor should carry out in relation to building of Miradi Limited, a company that has refused to depreciate buildings. We read from the question that the audit has been completed, but there is a matter that has not yet been resolved on depreciation of buildings. The directors of Miradi Limited have resolved that depreciation on buildings will not be provided for in the financial statements. So what audit procedures, additional audit procedures, should the auditors perform? The 4th audit procedure is evaluation of maintenance expenditure. You understand? Evaluation of maintenance expenditure or expenditures. The auditor should evaluate the maintenance expenditures. The auditor should review the company's records of maintenance expenditure that is incurred on buildings since acquisition. We saw that these buildings were bought in the year 2020. The auditor is carrying out the audit in the year 2023. So since 2020, what are the maintenance costs related to buildings? The auditor should assess, should evaluate, should review the company's records of maintenance expenditures incurred on the building since acquisition in the year 2020. The auditor should assess whether there are significant repairs or whether there have been improvements that have been capitalized, or whether there are any improvements since the buildings were acquired. Assess whether any significant repairs or improvements have been capitalized, and whether the expenses have been appropriately distinguished from maintenance costs. You understand? Because there are certain costs that are incurred on buildings that ought to be capitalized. Other expenses on buildings may be part of the normal expenses of for the company. So that assessment has to be done, and the auditor can only do that after evaluation of the maintenance expenditures. 5, comparison. The auditor can do a comparison with industry standards. What are the industry standards? That means that the auditor should do what we call benchmarking. Benchmark the company's depreciation policy and practices against industry standards and norms, and consider factors such as the average useful life of the buildings in the industry sector, and also the common depreciation rates used by peer companies. So this is Miradi Limited. We are not been given information on the industry in which this company operates, but whatever industry it is, whether it is a banking industry or agriculture industry or whatever industry, the auditor should benchmark the practices within the industry vis-a-vis what the company is currently doing in relation to buildings. What are the depreciation policies? What are the practices in the industry? And what are the standards? What are the norms in the industry compared to what the company is doing? Because industries may have certain average useful life for buildings. The companies may have a common depreciation rates that are used within that industry. So the auditor should compare the rates, should compare the various factors in relation to buildings compared to what happens in the industry. So comparison with industry standards. So this is an additional audit procedure. Another procedure is in relation to communication with third parties. Communication with third parties. These third parties could be experts or independent appraisers, industry experts, and so on. The purpose for this procedure is to obtain their opinion on the appropriateness of the company's depreciation policy and the condition of buildings. Do you understand? These are third parties, like experts, appraisers, and so on. Communication with third parties. Industry experts. So these are some of the audit procedures. They are not the only audit procedures. There are more. There could be more, but these are 6 audit procedures that the auditor can perform in relation to the buildings of Miradi Limited Company, which has not been providing for depreciation on buildings for the last 3 years. So the auditor here, I'm saying, should seek validation or additional insights to support audit findings. So these additional procedures candidates aim to enhance the auditor's understanding of the depreciation matter. These audit procedures may also help the auditor assess the impact of the decision not to provide for depreciation on the financial statements, and also to ensure compliance with accounting standards and regulatory requirements. That is the solution to that part. Additional audit procedures: number 1, review accounting policies. Number 2, assessment of depreciation methodology. Number 3, inspection of buildings documentation. Number 4, evaluation of maintenance expenditures. Number 5, a comparison with industry standards. Then lastly, communication with third parties. That is part A, Roman 1. A, Roman 2, assume that according to your workings, the depreciation charge on buildings for the year ended 30th June 2023 should be 4.2 million based on the straight line method of depreciation at an annual rate of 5%. Required, discuss the implications of the above on the financial statements, clearly indicating its effect on the audit report. This is Roman 2. We have to discuss implications of the above on the financial statements. The above is assuming, according to your workings, the depreciation charge on the buildings for the year ended 30 June 2023 should be 4.2 million on the straight line method depreciation at an annual rate of 5%. What is the implication of this? What is the implication if the depreciation was to be 4.2 million? What is the implication on the financial statements? This question is in 2 parts. Implication on the financial statements, then clearly indicating its effect on the audit report. We'll also discuss the effect of this information on the audit report. But first of all, let us discuss implications on the financial statements. Failure to provide for depreciation on buildings, despite being required by accounting standards candidates, has several implications on the financial statements and consequently on the audit report. So what are these implications on the financial statement? The first implication is overstatement of assets. Overstatement of assets. Now, since depreciation represents the systematic allocation of the cost of an asset over its useful life, not recognizing depreciation results in overstatement of the carrying amount of buildings on the balance sheet. And in that case, the building's value would remain at their original acquisition cost, leading to an inflated asset value. So ideally, depreciation is to reduce the cost of the building. But if depreciation is not charged, then the assets will be overstated. The asset will be overstated. We read from this question that the company has a net asset of 150 million. This is a total value of assets. That tells you that the value of 150 million is overstated because of the fact that the company does not provide for depreciation. And if this company has not been providing for depreciation for the last 3 years, and we have read in note number 2 that the depreciation charge, the auditor may have carried out this depreciation to be 4.2 per annum. If the depreciation charge is 4.2 per annum, and this company has not provided for depreciation for the last 3 years, you can see, candidates, the depreciation The accumulated depreciation is 12.6 million. So that means that the total value of assets, the net assets of 150 million is overstated by 12.6 million. That is the implication of not providing for depreciation on assets by this company. That's the first implication. The second implication is the overstatement of net income. The net income is overstated as well, because depreciation expense is deducted from revenue to calculate net income. And by not recognizing depreciation, the company's reported net income would be higher than it should be. And in this scenario, the absence of depreciation charge of 4.2 million would lead to the overstatement of net income, thereby distorting the profitability of the company. So, for example, if the company recorded net profit for this year of, say, 30 million, that means that net profit is overstated by 4.2 million. So that is the impact of not providing for depreciation on buildings. Number 3, distorted financial ratios. Distorted financial ratios. Now, the overstatement of assets and net income due to the omission of depreciation affects various financial ratios. For example, the return on assets ratio would be inflated, giving a false impression of the company's efficiency in generating profits from assets. Similarly, the debt to equity ratio could also be affected, as the inflated assets would lead to a lower leverage ratio. You may have other assets like the return on capital or return on capital employed, which is calculated by getting the ratio between the net profit and sales, or net profit and return on capital employed. So the omission to depreciate buildings could lead to distorted financial ratios. Why? Because the assets are inflated, net income is also inflated, and that could affect various financial ratios. That is an implication of not providing for depreciation on buildings. 4, misrepresentation of the financial position of the company, of the financial position of the company. Misrepresentation of the financial position of the company. Financial statements are meant to provide a true and fair view of the company's financial position. So, failing to recognize depreciation results in misrepresentation of the company's true financial position by overstating assets and overstating profitability. And these misrepresentation candidates could mislead stakeholders, including investors, creditors, and even the regulators. So that is the 4th impact for not providing for depreciation on buildings. The question required candidates also to highlight the effect of this omission on the audit report. If I can take the question again. Discuss the implications of the above on the financial statements. So these are the impacts on the financial statements, clearly indicating its impact on the audit report. Impact on audit report. What is the impact of this omission on audit report? Impact on audit report. Now, the auditor would need to issue a qualified or adverse opinion. The auditor may need to issue a qualified or adverse opinion. As a result of these effects of omission of depreciation of buildings on buildings, as a result of these effects or this omission of depreciating buildings has effect or impact on the audit report. One impact is that may lead to issuance of a qualified or adverse opinion. And that whether the auditor issues a qualified or adverse opinion depends on the materiality or the pervasiveness of the issue. And candidates here, a qualified opinion would be issued if the auditor concludes that the failure to recognize depreciation results in a material misstatement of the financial statements, but is not pervasive. On the other hand, an adverse opinion would be warranted if the auditor determines that the misstatement is both material and pervasive, meaning that it affects multiple areas of the financial statements. So that would be one impact. That may lead to issuance of a qualified opinion or adverse opinion depending on the materiality of and pervasiveness of the error. The audit report number 2 may also include a section discussing the basis for qualification or adverse opinion. There would be an additional paragraph. The audit report would contain a section. You understand? Discussing the basis for qualification or for issuing an adverse opinion. And this section would explain the reasons for the auditor's conclusion, including the failure to recognize depreciation, including the impacts of this omission to depreciate buildings on the financial statements. It would also highlight the departure from accounting standards and regulatory requirements. Additional paragraph. There will be a section explaining the impact of this mistake on the and so on. So these are two impacts on the audit report. Now, candidates, in concluding this part of the question, we can say that the failure to recognize depreciation on building has significant implications for accuracy and reliability of the financial statements, requiring appropriate disclosure and also qualification in the audit report in order to inform the stakeholders of the limitations of the financial information that has been presented. So the auditor has a duty to inform the users of the financial statements of the failure by the management to depreciate buildings. Failure to recognize depreciation on buildings has significant implications for the accuracy and reliability of the financial statements. You've seen how the failure of this failure can lead to implication on the assets. It has implications on the net income. It has implications on financial ratios. It has also implication on the truthfulness and the fairness of the financial statements, because we know that financial statements are expected to portray a true and fair view. But if there is an omission in depreciation, that can lead to misrepresentation of the financial position, which means that the financial position of the company as presented by the management does not present a true and fair view. So that is question A, but two had 8 marks. 1, 2, 3, 4, 5, 6. Any 4 points there would earn you 8 marks. Part B, audit risks associated with audit of financial statements. Now, candidates, financial instruments, we all know, present unique challenges for auditors due to their complexity and due to their inherent risks. So what are some of the audit risks that are associated with the audit of financial statements? So if you are to audit financial statements, what are some of the risks that are associated with audit of the financial instruments? Not statements, but instruments. Audit risks associated with audit of financial instruments. The first audit risk is the valuation risk. Valuation risk. Now, financial instruments are often valued using their fair value estimates, which can be subjective and prone to error. So auditors need to assess the appropriateness of valuation techniques, and the auditors also may need to assess the underlying assumptions used by the management. So when auditing financial instruments, the auditors must pay attention to the appropriateness of the valuation techniques and also the underlying assumptions that were used by the management to value the financial instruments. So valuation risk is an audit risk associated with the audit of financial instruments. 2, model risk. Model risk. Now, complex valuation models are sometimes used to determine fair value. And these models can be flawed or can contain errors leading to misstated financial instruments or even misstated financial statements. So auditors need to evaluate the control around model development and their use. So financial instruments are valued based on certain models. So there could also be errors in the development of these models, which can pose model risks. And when auditing these financial instruments, the auditors ought to pay attention to the models and the risks and how they are developed. There are also inherent risks associated with the audit of financial instruments. Number 3, inherent risks. Financial instruments are inherently risky due to factors like market fluctuations, factors like creditworthiness of the counterparts, and also liquidity issues. So the inherent risk associated with the specific instrument can be high, requiring extensive audit procedures. Inherent risks. 4, control risks. There are also control risks associated with the audit of financial instruments. The internal controls surrounding financial instruments may be weak, they may be ineffective, and that could allow for errors or fraud to go undetected. So auditors need to assess the design and also the operating effectiveness of controls related to financial instruments and also related to transactions around financial instruments and valuation. Control risks. Lastly, we have classification risk. There's also risk associated with classification. Financial instruments can be complex and may be incorrectly classified in the financial statements. And this misclassification can have a significant impact on the reported financial position and results. So auditors need to understand the classification criteria, and also they need to test the company's classification processes. Classification risks. There's also disclosure risk associated with the audit of financial instruments. Disclosure risk. The financial statements may not adequately disclose the nature and the extent of the risk associated with financial instruments. And insufficient disclosures candidates can mislead users of the financial statements. So auditors need to assess the completeness and the accuracy of disclosures related to financial instruments, like derivatives. So these are 6 audit risks. Candidates were to give 6 audit risks. 1 is valuation risk, 2 model risk, 3 inherent risk, 4 control risk, 5 classification risk, 6 disclosure risk. How many marks? These are 6 marks. 6 marks. Part A of the question, how many marks? This one, 6, this a point here, 6 marks. Then we have 6 part 2, implication on financial statements, 6 marks. These are 8 marks. Any 4 points will earn you 8 marks here. Total is 20 marks. So that is a suggested solution to the Advanced Auditing and Assurance December 2022 question 1. Thank you for attending the lesson. In our next session, we are going to answer question number 2. So please attempt question number 2 before joining our next session. Bye-bye.